Welcome back to the channel, where we break down complex financial topics into simple, actionable steps. If you're someone who doesn't have a lot of money but wants to start investing, you're in the right place. Today, we're diving into smart and safe investment options that are perfect for beginners or anyone looking to grow their money without taking huge risks. So grab a pen, because you're going to want to take notes. First things first, why should you invest? Simply put, investing allows your money to grow over time. Instead of just letting it sit in a savings account where it earns very little interest, investing can help you build wealth and reach your financial goals faster. Even if you don't have a lot of money right now, starting small can make a big difference in the long run, thanks to the power of compound interest. Every dollar you invest today has the potential to grow exponentially over the years. Let's start with one of the safest and most accessible options, high-yield savings accounts. These are just like regular savings accounts, but they offer a much higher interest rate. You're not going to get rich quick with a high-yield savings account, but it's a great place to park your emergency fund or any money you might need access to in the short term. The best part? Your money is FDIC insured, meaning it's protected up to $250,000. Next up, we have certificates of deposit, or CDs. CDs are another low-risk option where you deposit money for a set period of time, usually anywhere from 6 months to 5 years. In return, you get a fixed interest rate that's typically higher than a regular savings account. The catch is, you can't touch that money until the CD matures without paying a penalty. But if you know you won't need the money for a while, CDs can be a smart way to earn a little more interest safely. Now, let's talk about bonds. Bonds are essentially loans you give to a government or a company in exchange for regular interest payments plus the return of your principal at the end of the term. U.S. Treasury bonds, for example, are considered one of the safest investments in the world because they're backed by the full faith and credit of the U.S. government. Corporate bonds can offer higher returns but come with slightly more risk. The key with bonds is diversification. Don't put all your money into one bond. Spread it out across different types and durations to minimize risk. For those willing to take on a bit more risk in exchange for potentially higher returns, let's talk about index funds. Index funds are a type of mutual fund that tracks a specific market index, like the S&P 500. When you invest in an index fund, you're essentially buying a small piece of all the companies in that index. This gives you instant diversification, which is one of the best ways to reduce risk in the stock market. Index funds have low fees, and historically, they've outperformed most actively managed mutual funds over the long term. The best part? You can start investing in index funds with just a few dollars. Speaking of the stock market, another option to consider is exchange-traded funds, or ETFs. ETFs are similar to index funds but trade like a stock on an exchange. This means you can buy and sell them throughout the trading day, unlike mutual funds, which only trade once a day. ETFs offer the same diversification as index funds but with a bit more flexibility. They also come in a wide range of options, from those that track entire markets to those that focus on specific sectors or themes. For those of you who are interested in real estate but don't have the cash to buy a property, consider real estate investment trusts, or REITs. REITs are companies that own and operate income-producing real estate, and when you buy shares of a REIT, you're essentially investing in real estate without having to deal with the hassle of owning property. REITs pay out most of their income as dividends, making them a good option for generating regular income. Plus, you can buy and sell REITs just like stocks, making them a liquid investment. And finally, if you're really starting small, consider micro-investing apps like Acorns or Stash. These platforms allow you to invest tiny amounts of money, sometimes just your spare change, into diversified portfolios. It's a great way to get started with investing, especially if you're nervous about putting a lot of money into the market. Over time, these small amounts can add up and help you build a nice investment portfolio. Remember, the key to successful investing is consistency. Start with what you can afford, and keep adding to your investments regularly. Don't get discouraged by market fluctuations. Over time, the market tends to go up. And most importantly, always do your research or consult a financial advisor to ensure you're making the best decisions for your personal situation. So, there you have it, several smart and safe investment options that are perfect for beginners or anyone looking to grow their money without taking on too much risk. Whether you're starting with a high-yield savings account, dipping your toes into index funds, or exploring micro-investing apps, the most important thing is to start. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss a new video. Happy investing!